Japan has made a move that has sent shockwaves through the global financial system, one that could reshape the economic landscape of the United States for years to come. By significantly reducing its holdings of US Treasury bonds, Japan has signaled that it is losing confidence in the American economy, an action that has left President Trump in a state of panic. The US stock market has already lost a staggering $1.7 trillion, a collapse that has left investors scrambling and policymakers deeply concerned. With the world's third-largest economy distancing itself from the US dollar, what does this mean for the future of American economic dominance? Before we dive into the details, make sure to subscribe to the African Web to stay updated on how these financial shifts impact Africa and the global economy. For decades, Japan has been one of the largest foreign holders of US Treasury bonds, serving as a key financier of America's debt. As of last year, Japan held over $1 trillion in US debt, second only to China. This has allowed the United States to maintain its high levels of government spending without facing immediate financial collapse. However, recent geopolitical and economic shifts have led Japan to rethink its strategy, and the results are now unfolding. Japan's decision to offload massive amounts of US Treasury bonds is not just a routine financial move. It is a direct signal that Tokyo no longer views American debt as the stable investment it once was. With Japan reducing its exposure to US bonds, other major economies might follow suit, setting off a domino effect that could cause an even greater financial crisis. Over the past few months, Japan's bond sell-off has accelerated at an unprecedented pace. Analysts speculate that Japan's central bank is positioning itself for a world where reliance on the US dollar is no longer a guarantee of stability. The impact of this decision is already evident, with US bond yields rising, making borrowing more expensive for the American government. The ripple effects are also being felt in financial markets, as investors fear that a major withdrawal of foreign capital could spark a wider sell-off. This massive shift has not gone unnoticed by President Trump, whose administration now faces increasing pressure to stabilize the economy before the situation worsens. One of the biggest triggers for Japan's decision to reduce its US bond holdings has been Washington's recent trade policies. President Trump's administration imposed tariffs on Japanese electric vehicles, EVs, as part of a broader strategy to protect American car manufacturers. This move was met with immediate backlash from Tokyo, which views these tariffs as unfair trade restrictions that could harm Japan's auto industry. In response, Japan has decided to hit back, not through direct trade measures, but through economic warfare. By reducing its US bond holdings, Japan is indirectly weakening America's financial standing. The US government relies heavily on foreign investment in its debt to keep its economy afloat, and a significant drop in demand for Treasury bonds could force Washington to raise interest rates to attract investors. This, in turn, would increase borrowing costs for businesses and consumers, slowing down economic growth. Japan's retaliation sends a clear message. If the US continues its aggressive trade policies, it will face severe financial consequences. Trump's economic team is now scrambling to respond to this unexpected challenge. While tariffs were initially introduced to strengthen America's domestic industries, the backlash from international partners like Japan could have the opposite effect. The auto industry, a key pillar of the US economy, may now suffer as Japan redirects its investments toward other markets. With Japan's financial retaliation setting a precedent, other nations targeted by US tariffs could adopt similar strategies, leading to an even deeper economic crisis. Japan's move is part of a much larger trend that is reshaping global finance. In recent years, several countries, including China and Russia, have been actively reducing their reliance on the US dollar. This shift is fueled by concerns over Washington's use of economic sanctions, trade wars, and monetary policies that prioritize American interests at the expense of global stability. Now, with Japan joining this movement, the dollar's status as the world's reserve currency is facing an unprecedented challenge. Tokyo's financial policymakers are reportedly exploring alternative ways to diversify Japan's foreign reserves, including increasing their holdings in gold and other currencies. Some analysts believe that Japan could deepen its financial ties with China and other Asian economies, further reducing its dependence on the dollar. This could lead to the rise of a new financial system in Asia, where regional currencies and digital assets play a larger role in global trade. If this trend continues, the consequences for the US economy could be severe. A weakened dollar would mean higher inflation, as imports become more expensive for American consumers. The US government would also struggle to finance its debt at current levels, potentially leading to spending cuts that could impact public services and infrastructure projects. With Japan's actions accelerating this shift, the United States must now reconsider its financial strategies to prevent a full-blown economic crisis. The immediate impact of Japan's sell-off has already been felt in the US stock market, which has lost $1.7 trillion in value. This decline reflects growing investor anxiety over America's financial future and the potential instability of the dollar. As the demand for US Treasury bonds decreases, interest rates are expected to rise, making it more expensive for businesses and consumers to borrow money. This could lead to a slowdown in economic growth, increased unemployment, and a potential recession. Another major concern is inflation. With the dollar losing value, the cost of imported goods will rise, further straining American households already struggling with high prices. The Federal Reserve may be forced to hike interest rates again, a move that could stifle economic growth even further. In a worst-case scenario, a prolonged sell-off of US bonds by foreign holders could trigger a financial crisis, similar to the 2008 recession. Beyond the US, global financial markets are also on edge. Countries that hold large amounts of US debt, including China and Saudi Arabia, are closely watching Japan's actions. If they decide to follow suit, it could lead to a cascading effect that destabilizes the global economy. As the world shifts away from US-centric financial systems, the United States risks losing its dominant position in international trade and finance. The Trump administration now faces a difficult choice: either reverse some of its protectionist trade policies or risk further economic turmoil. While lifting tariffs on Japanese EVs could ease tensions and potentially slow down the bond sell-off, such a move would be politically risky for Trump, who has built much of his economic policy on protecting American industries. If Japan continues to reduce its holdings of US debt, Washington may be forced to rethink its approach to international trade and diplomacy. At the same time, Japan's decision highlights a broader shift in global economic power. With the US facing increasing financial pressure from both allies and rivals, the future of the dollar as the world's dominant currency is now in question. If this trend continues, we could be witnessing the beginning of a new era in global finance, one where America no longer calls the shots. What do you think about Japan's bold move? Do you believe the US will be able to recover from this financial setback, or is this the beginning of a long-term decline? Share your thoughts in the comments, and don't forget to like, share, and subscribe to the African Web for more in-depth analysis of global economic trends.